now we want to go to the inventory on hand. Let's see. You can see that 1000 pieces of t-shirt added in your inventory as it is finished goods. We actually did not purchase this 1000 unit. We produce here in production house, and now as the price you can see here, these are the only material price, 35,000. On the other hand, you can see the materials are reduced to the 1000, 1 lakh quantity to 99,000 here, for accessories 1 2 3 and 4, and the fabric we used the fabric 2, 1500 meter from here, and it reduced by 1500 meter in fabric 2. So a t-shirt style no 001 added 1000 as the production quantity, produced quantity. Actually, we made this quantity in factory, which you can, if you click here, you will see the details. Here you can see the material cost of the individual item of the raw materials we actually use. As a management accountant, now you don't want to see this cost in manufacturing expenses or cost of goods sold. You may want to you transfer this cost directly to the 1000 pieces of the produced t-shirt, as these costs are related to the finished goods we produced earlier in the production orders. As you can see in the description, this is labor cost for 1000 pieces of this. So you can identify this cost, so it shouldn't be here. It should go to the product costing. It should be transferred to the product costing. So how you will do it? Let's see. Okay, just go to the production orders we created earlier. So edit. Now you can see the add non-inventory cost into the production. So we if you click here, now you can add your factory related or production related overhead costs to this production, a specific production order. So we gonna add those production related cost to the production order. And now we added direct labor 30,000. We added factory electricity 10,000. We also added other factory overhead 20,000. So now you can update. You will see these are the material cost and these are the factory overhead, one by one added to the production order. Now the pricing of 1000 t-shirt is 95,000, which was actually 35,000 before adding factory overhead. And now you can see the proper pricing of your have a look this now in the manufacturing expenses. Now there are no factory overhead cost available now, because we transferred this cost to the inventory finished goods, of which are related to the costing of finished 1000 uh, 1000 t-shirt, which are the finished goods. So let's click to the inventory on hand. You can see and 95,000 of the pricing. And if you want to see the unit price of each quantity, you can go to the report. You can go to the report, and now inventory summary as the inventory value, inventory quantity, profit margin, and inventory costing calculation. You can see here. Let's say description. So what to do? Weighted average. And now you can see the unit price of the each quantity of your finished goods here. Inventory costing calculation. What will happen when you sell from finished goods warehouse? we will create a sales invoice. Let's say we have just one customer. We will going to sell t-shirt sold to customer. Okay, we have only one finished goods item right now. So we will select t-shirt from item and inventory. You as we selected the item, now it will go to the inventory cell. Accounting had automatically selected by the system as this is the built-in function of this cloud accounting software. So now that you will put the quantity. Let's say we going to sell 300 pieces of the finished goods item from our finished goods warehouse, and unit price 120 taka per piece, and create one. And now you can see the invoice, sales invoice, and to Mr. X, this is the credit sales. So you will see the receivable in a dashboard. Let's go to the dashboard. Here you can see account receivable 36,000. We are yet to receive this amount for selling your finished goods item. And now you can see in the sales inventory sales, here inventory sales, you can see 36,000 is sold from your finished goods warehouses. You just produced earlier. And now you can see the related cost of these items are added to the manufacturing cost. As you can see, the inventory cost 28,500 is your cost of sales actually. Now if you click here, you will see the details. You can see the details. These are related to this is actually automatically calculated by the software. You don't need to provide any adjustment journal entry for manufacturing cost or cost of goods matter the cost of goods sold earlier. This cost is actually related to the 1000 pieces of production cost. If you multiply 95 by 300, as we just sold 300 pieces of software of the finished goods. So if you multiply 300 by 95 is the unit cost of the production we produce. When we produce 1000 pieces of finished goods, you will get this figure. Let's go to the inventory on hand again. And now you can see this is the 1000 of finished good t-shirt is now 700, because 300 we already sold from sold from here. So it is now 700, quantity is 700. Now will be tracked by the system. It is transaction by transaction. When you this is actually movement of the inventory. The raw material actually moved from here to the finished goods, and now finished goods is moved to your customers when you just sell your finished goods item from here. And now cost is you can see that cost is reduced by 28,500 as the cost of the 300 pieces the sold item from here. So this actually how perpetual inventory management work from by cloud accounting software. So now you can track your inventory on hand, physically have in your warehouse. This is how actually inventory and production management work in production in cloud accounting software. So if you have any query regarding inventory management and production management in cloud accounting software or chart of account, you can contact with us. So thank you so much.